day everyone, my name is Tian Yong and I'm an investment analyst with Phillip Futures. In today's Market Watch, we will be touching on a few of the major developments in the Singapore space. Earlier, on the 13th of April this year, the Ministry of Trade and Industry reported that Singapore experienced a quarterly GDP contraction of negative 1.9% for Q1 2017. This was in stark contrast with the strong 12.3% reading seen in Q4 2016. Delving deeper, it can be discerned that major drags on this growth reading stemmed from a quarterly decline in the manufacturing industry, with key dampeners observed in the transport engineering, general manufacturing and biomedical engineering space. Given this data release, a few reasonable questions to ask as a market observer would be, what's next for the Singapore economy? Is everything going to be okay? To gain some preliminary insight to these questions, a good starting place would be the Monetary Authority of Singapore's recent monetary policy statement. In this statement, the MAS shared its economic outlook for the Singapore economy for 2017. In light of the latest GDP data release, it was mentioned that growth will remain modest in 2017. This may also explain why the MAS has also decided to keep its neutral policy stance for an extended period of time, as the Singapore economy is presently not weak enough to warrant easing, while at the same time not showing adequate signs of strength to justify policy tightening. In the Singapore equity index space, initial reactions to the recent Q1 2017 GDP growth figure were less than optimistic. The Straits Times Index and the MSCI Singapore Free Index opened lower following the news. In a broader view of things, Singapore equity indices may be facing serious stalls to the previous New Year rally soon. From a technical perspective, the MSCI Singapore Free Index has already begun to show signs of momentum fatigue as prices test its 20-day slow-moving average as denoted by the red line. Watch for a possible breach under this line to indicate an imminent consolidation in prices. The index's 14-day RSI has also been showing a protracted period of trend divergence with index prices. This also points to a possible turn in the index from its previous uptrend towards a sideways or a downwards trend. The fatigue exhibited by Singapore equity indices was in light of recent developments both domestic and abroad. Domestically speaking, the bleak and sluggish economic outlook for the Singapore economy gave little reason for equity indices to soar. Abroad, dampened sentiment in the US equity index markets rubbed off as well. For instance, the US equity index markets are exhibiting stalls to the previous Trump rally in light of mounting doubts over US President Trump's ability to deliver his tax cuts and infrastructure spending, while geopolitical tensions between the United States, Syria, China, Russia, and even North Korea rise. These factors hampered the previous upward momentum Singapore equity indices enjoyed earlier in the year, and as a result, new reasons for cheer have to be found before any uptrend persists. Well, that's about it for this issue of Market Watch. While things may seem dreary and beat down during these uncertain times, it may well mean that better days are yet to be. Please subscribe to us on PhillipCapital YouTube channel and Facebook for more videos. Once again, this is Tian Yong, Phillip Futures Investment Analyst, signing off.